I'm Dave Spano, President and CEO of Annex Wealth Management, joined in the studio by Derek Felske, Chief Investment Officer. Good morning, Derek.
Good morning, David.
So much to talk about. We really have to talk about Friday morning when we saw a jobs report, an expectation of 600,000. Now, that came in much less than what we expected, but you really got to dig into it to understand it.
Right. We added 210,000 jobs in November. There were major upgrades to the August and September gains, so the number was stronger than it initially appeared. And generally speaking, the trend in labor continues to be positive. Wage growth is positive. We're adding jobs, and there are still tons of job openings out there that people are looking to fill.
Yeah, no question. So the number we look at, the U3 number, is now at 4.2%. Of course, the Fed wants to get to maximum employment, and that's getting pretty close, that's for sure. But the key number, as you said, more people came back in. So even though it showed 200,000, 600,000 people came back in. And what we don't know is if people are having gig economies, doing gig jobs, or if they started their own business. So the economy is doing well, and we saw that out of a number out of Atlanta Fed, Derek, that is just a blockbuster.
Right. Just a week ago, they were forecasting 8% growth in Q4. Now it's closer to 9, somewhere between 9 and 10%. Just a huge reacceleration from the 2% number we saw in the third quarter, which should bode well for earnings season as we approach January.
Yeah, that's right. So, the reason why we bring these economic numbers up is because we looked at this jobs number. It's something that the Fed, of course, has to pay attention to because one of their mandates, of course, is maximum employment. But this week, they were grilled, the FOMC, especially the Fed chair, was grilled by Congress. And one of the things that, you have to laugh about it because we've been talking about transitory as a term for nearly 6 months. Well, they gave it to him pretty good this week.
They did. He backpedaled on transitory. He said we should eliminate that from the lexicon. And we talked about transitory, and there's different ways of approaching it. There were certain elements in inflation that we've seen recently, whether it was big upticks in used car prices, huge bounces in lumber and copper prices and things like that. And those things probably are transitory. But what I think Powell acknowledged is that, the really important numbers, wage growth and owner equivalent rent, are in an uptrend. And so inflation will persist for a while. The Fed has wanted to overshoot their targets, and they certainly have accomplished that mission.
Yeah, of course, they should listen to the show because, you and I have been talking about those inputs are not transitory. And of course, he did say that he wants to retire the term transitory and talk about more of things like what's on their plate. And one of the things that is on their plate, Derek, is that they're going to talk about and actually start to do more tapering. They initially said it was going to be $15 billion a month. They're going to accelerate their tapering. Explain what that means.
Well, he said they will consider it. Again, it's going to be data dependent, as everything with the Fed is, and the taper path really determines, at what point rate hikes could potentially happen. As I've said over and over again for months, tapering is not tightening, so the Fed is remaining accommodative, just a little bit less so at the margin. And until they finish the taper, you're not going to see interest rate hikes. So depending on the taper path, that could be, could be as early as March of this year, or it could be as late as, say, June or July or August. And again, that's going to be because the economy's on strong footing. So people that are freaking out about the fact that the Fed is becoming a little less accommodative, I think, are making a mistake.
Yep, so exactly right. And we've talked about that for a long time, that tapering their purchases of their balance sheet is not tightening. In other words, that does not mean raising interest rates, which, of course, is something that the market probably could handle with this inflation concerns right now. So we're going to continue to watch that because, of course, rising rates puts pressure on all types of securities.